Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, it is still of great comfort here, even after the falls, rises, and now the recent falls once again, that this market still keeps within the broken May to October 2020 bullish shift pitchfork that was originally drawn, well, now over a year ago. To recap some of the recent significant actions, prices had moved down since this past August from the upper time, currently at 24.85, through the middle time, currently 23.15, all the way down to the lower time, currently at 21.45, where they were halted to a great degree by the combination of the slowly rising long moving average, currently at 21.99, and the big 50% Fibonacci lines of the March to August move at 21.60, plus the February 2018 to March 2020 move at 21.28. The market consolidated, and in early October started to rise back up again, back up through all those previously mentioned supports that were now resistances, peaking out 4 weeks ago at the upper time, currently at 24.85. The current move down is now looking like a failure of the carefully constructed bullish diving board pattern seen between August and the end of October. To give you a quick explanation, the action from early August to mid-September was a diving board. The drop from mid-September to the low of late September was a dive off the board, and the move back up from early October to late October was the swim to the shore. It is not an uncommon pattern, but it is one that has been valid until the recent fall since late October. Now, the initial topside target X for this pattern would be in the 24.11 area, with possible secondary target X1 in the 24.63 area. As you can see, target X was achieved 5 weeks ago, and if it wasn't for having the upper time in the way, I am fairly certain we would have also achieved target X1 on the top as well. Thus, last week I called this pattern achieved and will after today retire both targets X and target X1. The future now depends, as I put it last week, and I quote, on whether the action from the start of October to now is either a topping action, the pattern which is yet to be determined, or a possible bullish halfway hesitation, maybe even a bull flag. End of quote. That is why I suspect that this week we may have that answered, and right now it looks like a topping action. In the big picture of things, it is still in some ways too early as yet, and it would be reasonable to give the market some more time to determine its intent. However, as I said at the time last week, and I quote, that does not stop seeing further immediate declines, especially to the October 2019 high. End of quote. Well, last Wednesday the market broke down through the October 2019 high at 22.63 for a second consecutive bearish closing Black Mariposa, dropping down to halt these past 3 sessions on the key 50% Fibonacci line of the June to October 2018 move at 22.21. Now, don't get me wrong, the 50% Fibonacci line at 22.21 is a legitimate support, and a good one. However, how strong would you imagine it would have been without the help of the nearby slowly rising long moving average, currently at 21.99, that is just below? To have an idea of what that might have looked like, just take a look at the drop in late September when they were well separated at the time. Anyway, the past 3 sessions may be a nascent bullish 3-day morning star pattern, which can explain why we've had a move up today. However, the top side seems limited, as overhead we now have the flatlining short medium moving average, currently at 22.74, and the medium moving average, currently 22.92. Thus we have a choice right now. Take on the long moving average below, or take on the short medium moving average and medium moving averages overhead, or trade in between. Personally, I'm not sure, though I am more inclined to leave the long moving average below alone for now. LME 3-month tin. I'm sorry if you've heard the first bit before, but it is necessary, I'm afraid. So here goes again. I've been repeating this here again and again for months and months now. The overall bullish incentive is still alive, well and strong here. This was and is because of the original move up within the January to March bullish shift pitchfork, which had started back in March and then translated to a higher level in April, resulting in prices moving up over the middle time, currently 37,525, of the January to March bullish shift pitchfork. Prices even managed to reach up and over the upper time above, currently at 39,910, back in July, August, mid-October and as recently as last week. Yet in all that time, prices have always come back within the folds of this bullish pitchfork, as it did late last week, and also this week. In all the time since March, this bullish pitchfork had and still has driven prices higher. Now admittedly, I, and I'm sure you as well, believe that no market can head in one direction all of the time forever. Thus we saw major corrections back in August, late September, and most recently 4 weeks ago. It is important to note that despite these corrections, the market in all its pullbacks down has not managed ever to break the same bullish incentive that has been here since March. The evidence for this can be seen by how this market is still today well within the bullish shift pitchfork. Currently over the middle time, that's currently at 37,525, and travelling upward along it, nicely along it. Another point to note, and this may become very important, if the lower time, currently at 35,145, is challenged, then one should take into account that this lower time has been married to its long-term partner, the rising medium moving average, currently at 35,095, since at least August. It may well be that if we see a separation of these two between the lower time and the medium moving average, then perhaps we may start looking at the bullish incentive as maybe finishing. This is no more than a conjecture on my part at this time, but it does have a certain symmetry to it. So I suggest special attention to those two. And this brings me once again to my final point, the same final point that I have repeated from previous commentaries. It is, and I quote, "It can be hellish to rely on only one pattern, because it can be hellish when it breaks." End of quote. So that's it. That is where we are now, once again. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.